15 seconds to go. FNO expiry from a breakdown to a breakout, 1 month and a 5% move on the Nifty. It's turning out to be a good April. Will it be a sunny May as well? Sunny in terms of temperature for sure, but I'm not so sure sunny in terms of the market action. For the moment, it's a good start, and it's a start where the market breadth I think is inching up very, very smartly. The market breadth is looking strong. 1:3, 1:4 stocks are advancing versus declining. SBI Life, Wipro, Adani Ports, BPCL, Bajaj Finance. I'm speaking the stocks in the same breath. You've got Wipro, which is looking strong. You've got Maruti, which is giving it some company, and Reliance is now marching towards 2375, 2400. If it does, then there is a bit of a catch up it will be doing. HDFC Life, even though numbers are strong, I'm surprised why there is a lot of red on the screen. But remember, the stock had run up after that RBI clarification came on holding of RBI. I think that was on Monday, so the stock already did its big buy the rumor, sell the news kind of jump. But Tata Consumer is where you want to go, and you want to definitely go back to RVNL. RVNL yesterday reversed completely. Is it gaining traction? No, it is not. It's become a Navratna. So what? Stock was at 150, now 103 in matter of 124 hours, and it's taken a complete U-turn.
Oh, well, yes, that's about RVNL. But look at the City Union Bank stock surging as we speak, 8% higher, the level of 143 on that one. Then Shoppers Stop, which has been a turnaround story, reporting a profit this quarter versus loss last year, is gaining 5%. UTI ANC is another result reaction. Ditto can be said for Syngene, KPIT Tech, L&T Tech as well. All of these counters are quite excited, and Indus Tower 2 managing to hold in the green. What's on the back foot clearly is Voltas. That's seeing a cut of almost 2%. And some of the Gujarat PSUs that were rallying yesterday are seeing a bit of a profit booking today. So JSFC, Gujarat Alkali, these are some of the counters which are on the back foot as we speak. Sectorally speaking, it's Realty, which is the top gainer, while metals, media, pharma, they're all on the back foot today. And of course, you also want to watch out for what's happening with respect to Bajaj Finance, because there's a very interesting note coming in from a CLSA, and the headline says, Kohli's aggression, Dravid's defense, and that's exactly what the numbers do look like, Avan.
Absolutely, that's a pretty interesting report. I was just taking a look at that headline as well. You've highlighted a lot of the movers. We're awaiting a whole host of numbers today. Earnings did come out post-market hours as well, but let's find out what our chartists are, punching in as their first trade. Expiry day, so bound to be quite a bit of choppiness. Kunal, in light of that, what's the trade?
Well, DLF is a stock which I would, look to trade in the open as well as recommend, because I think that stock is confirming a breakout more on the positional time frame chart. So I think that's a stock which I would be extremely interested by.
What about you, Nooresh? What's the first trade?
So continuing to accumulate Apollo Hospitals, which I expect to eventually break out. Could take some time here at 43.50, 44.50. But once it breaks out, could be a quick move to 4900.
Is up and running. That's what happens when markets think that the franchise is old, it's a matured business. They come out and they surprise you with a 30% AUM growth. And look at the balance sheet size of Bajaj Finance. It's not like a 50,000 crore balance sheet. On that balance sheet, if the AUM is growing at 30%, A, it's a huge multiplier to India's nominal GDP, and B, it is also an indication that how efficiency and market share gain are at play for Bajaj Finance. Not other, I can guarantee that other NBFCs will not see this kind of an AUM growth. Sheshadri Sen joins us now, represents Alchemy Asset Management. Let's take our conversation forward with him. Sheshadri, good morning. Thank you for joining us. I can see you joining us from your office. That lovely painting. When I come to your office, I just admire that painting behind your back.
Yes, it's a brilliant one. Thank you.
That's the bull, right? That's the big bull which you have at your back.
Absolutely.
Okay. Is it time to now get realistic about the risk-reward ratio? In the month of Feb and March, there was opportunity because markets had sold off. But now markets have come back. Bank Nifty is up 9% from the low, Nifty is up 5% from the recent low. Do you think the bargains in the market are missing?
Yeah, I do. I think, if you take a one-year view, we think that there's upside. Markets will largely track earnings growth, where for the Nifty at least we are at 15%, and this was the number I checked before the fourth quarter earnings started to come through, and we may see some revisions there. But yes, I don't think we are in a sustained run. It will be a volatile time for the broader markets. There is still, if you take a one-year view, there is still upside. It's not a massive upside, largely, as I said, tracking earnings growth. But be prepared for volatility because interest rates are high, and while further hikes are unlikely, we don't think they're coming down in a hurry either.
Things be volatile. I mean, aren't all the concerns getting addressed one by one? Inflation, rupee, macros, Adani fiasco. If concerns are getting addressed, why do you think we should be in for? Why should we brace ourselves for volatility, not a clear move?
You're right, and I think that the fact that those concerns have eroded have played out in prices. But if you look at pure fundamentals and you look at earnings growth versus valuations, we are at fair point. We are neither overvalued nor undervalued. Valuations in the last 6 to 9 months have corrected significantly. So the worry that was there, say middle of last year, that India's overvalued has gone away. But neither is it like compellingly cheap on the other side. The volatility is on the trajectory of earnings. We think that there will be a broad consumption slowdown in 2024 or in FY24 based on a high base effect, the fact that there was a lot of post-COVID front-ending in many categories, which is yet to really unwind. And therefore, discretionary demand, except for autos, continues to be challenging, and the commentary does not seem to change from whatever we've heard so far. Yes, there is upside in margins, and that is what's driving the 15% consensus earnings growth for next year. But in a situation where demand is weak, there is a risk that companies may choose to pass on those margin benefits to consumers to get more volume, and some of those margin benefits may not get realized. So, on the other hand, if you look at an investable group of companies, high quality companies, valuations individually are not cheap. Some of the manufacturing companies are now trading, almost like consumer companies in terms of valuation. So this is a situation which is ripe for volatility. You could see some earnings challenges, maybe not on the broader market, but individual companies' earnings upwards and downwards revisions could be fairly dramatic. And that always leads to volatility, at least at the individual stock level. So yes, meaning I don't think volatility has gone away. But you're right, from a one-year perspective, most of the concerns have receded, and therefore we remain constructive on the markets, and we think the markets will track earnings growth from here.
Okay, so you're still constructive on the market and most of the worry you believe is out of the picture, but can't say the same about IT sector, right? There are a lot of concerns with respect to the fact that growth might slow down further. There could be a further derating of the sector. How are you approaching the IT pack? Still remain bullish?
You're absolutely right. I think between the beginning of the year and now, the situation on the IT side has changed dramatically, and that is because the smaller US banks seem to be in struggling, and therefore the demand impact from that category has impacted most of both large and small IT players. So we are cautious on the IT space. We will look at it individual stock wise. It has to be looked at from each stock has to be looked at from the perspective of three things. One is near-term demand and the possibility, as you said, of further earnings revisions, whether that is a risk. Two, where valuations are, and on that front, many high-quality stocks have derated significantly. So, apologies. So, in that case, you will see some stocks where near-term outlook may be weak, but valuations could look compelling. And so once you combine these, one has to take an individual stock-based view. One also has to look at which segments each IT company is exposed to and take a view on that basis. I don't think the broader sector will give you a rally. If you just buy the index, I'm not sure that that's a good idea. One is to look at each individual company, and while the broader index may not do well, there could be some companies which could provide compelling returns in the next 1 year.
We spoke last time about banks. You've tracked financials for years now. banks are in a sweet spot, but are markets pricing in FY25 and FY26 earnings also?
No, I think that's a tad unfair. With banks, what one has to brace for is that FY23 was the best year for banks in a long time. Everything went right, right? Margins went up, and fee income was strong, and credit costs collapsed. If you look at the next year, on a full year basis, margins will be stable to maybe slightly down. But on a quarterly basis, if you have noticed during FY23, margins sequentially went up every year. So from the exit margins in fourth quarter FY23, margins will certainly come down. Now, whether that happens in the first or the second quarter, one does not know. That is never a good thing for bank stocks. Credit costs, while this is as one banker said, an absolute sweet spot for asset quality, retail and wholesale in India. They can't come down much, not enough to impact earnings in a significant way from here. And you will find that as some of the more prudent banks are doing, even if delinquencies are low, they will continue to make provisions to shore up the balance sheet. So there's not a great deal of upside from credit costs from here. So earnings growth will be challenged. And when you're coming off such a high earnings growth in FY23, FY24 earnings growth will look a little anemic. However, valuations are not egregious at all. Valuations, if you look at a price to book basis, it's not that they are in the fours and stuff that one has to worry about derating. So the short summary is that banks will perform largely in line with earnings growth or book value compounding, and not significantly deviate from there. There will be volatility because the margin compression that we are going to see on a quarterly run rate basis could cause some volatility. But if you're looking at banks as a sector to drive outperformance, that is probably a little difficult. One has to dig deep and look at individual stocks to try and look at alpha ideas.
Seshadri, wanted to understand as well your outlook on the crude oil price movement and what the implications could be on individual sectors and for the Indian economy as well.
Well, I have a tough enough job. Forecasting crude is just adding to my stress. But meaning for whatever, I don't think that crude will spike majorly, and India has shown remarkable resilience to crude prices. So our base case is that crude remains in a narrow range, and we don't think that will cause either a major macro or a micro impact. If crude actually remains stable at current levels, within a narrow range, actually, as we get into the year, manufacturing margins will start to improve because they will benefit from passing on price hikes while raw material prices may not go up that much. Could I be wrong and there could be a major spike in crude prices? Looks unlikely in a situation where you have to look at it in a larger context where the whole world is under tight monetary policy. The Western economies are significantly slowing down. I can't see a situation where crude spikes significantly from here. But as I said, it's a tough job forecasting crude prices. But our base case is that it remains in a narrow range, and that will have limited impact on the economy and on companies.
So, if one has to understand the themes for Alchemy Asset Management for FY23 and for FY24, where are you taking outsized bets? I mean, financials, IT, those are tactical calls, but I'm sure you're taking some outsized bets where stocks which are young and you want to see them grow.
Well, I would say that if there's one theme that I would have to pick, it is manufacturing, especially in mid caps. That is where your story is. Because we're coming out of a long winter, right? The previous decade, manufacturing went through a really, really bad cycle, right? From every angle, from top line growth to margins and down to, balance sheet stresses. And that was partly because many of the companies made bad capital allocation decisions. We are now in a, starting from the early part of this decade, we are now in a longish cycle of capital expenditure, manufacturing growth, relocation of manufacturing back to India in a small way. I'm not saying that's a major, but in a small way. But, that's enough delta to move the needle for many of these companies. This is not a short-term cycle. We think this is a fairly strong medium-term cycle. The nature of the sector is that most of the stocks are mid-cap. There are very few really large-cap stocks left in manufacturing, capital goods. And by manufacturing, I mean a large swathe. Even chemicals, etc., are part of our manufacturing story. The only worry is that a lot of that has been priced in. And as I said at the beginning, a lot of these companies are now trading at multiples, which are a little scary. But it's such a large universe that one can continue to dig and find stocks which have great short and long-term outlooks, but are still not, egregiously expensive. So if I had to pick one theme, it would be manufacturing, and almost by definition, that has to be played through a mid-cap to, the lower end of the large cap regime. Your ultra large caps, are fairly underrepresented in manufacturing.
Well, Shraddha, really appreciate your time. So glad you could join us with your thoughts. India's largest car maker, Maruti Suzuki, will set up additional production capacity of 1 million units to meet increasing demand for the cars, both in the local market as well as the export market. The company has also announced an aggressive foray into the EV market with 6 new EV models planned by 2030. My colleague Somit caught up with the chairman of Maruti, Mr. R.C. Bhargav. Let's listen to his interaction.
The reason is that our projections of demand going forward till about 2030, 31 indicate that there is a gap in our supply position compared to what we think the demand is likely to grow to be, including the export demand. Because the big difference from earlier times is in the quantum of exports, which we think will happen by 2030, 31. And that change in the export situation is primarily what is driving the need for adding extra capacity.
And so talking about the margins, they are once again above 10% after FY21. Are they sustainable? What about the overall margin picture going forward as far as the profits are concerned?
I don't think anybody can predict margins going forward in any industry. It's just not possible. There are so many variables which are there, and the world today is not a very predictable place. The number of changes and unexpected events which happen are enormous. So please, I mean, I am not at all capable of predicting futures in margins.
So let's talk about chip problem. When last year you suffered chip problem, it was a serious problem that time. What about chip problem going forward? Last year you, in a way, it led to loss of many units. What about this year? Will it be as grave as last year, or are you seeing an improvement when it comes to the problem with chip or semiconductors?
Our expectation is that 23-24 will be better than 22-23 as far as chip availability is concerned. However, this first quarter of this year is still not showing that improvement, but we do expect that from the second quarter onwards, there will be an improvement in the chip situation.
So talking about electric vehicle roadmap, you said that by 2030, 6 more EVs would come. Can you throw some light on your partnership with Toyota as far as EVs are concerned or hybrid vehicles are concerned? And will you partner with other Indian or global manufacturers when it comes to electric vehicles?
We don't have a partnership with Toyota. The partnership is between Suzuki Japan and Toyota Japan. But as a consequence of that partnership in Japan, in India, we have this system where not only does Suzuki pass on technology and other things from Toyota to us, but Toyota vehicles manufactured in India and Suzuki vehicles manufactured in MSIL, there is an exchange of vehicles in the sense that they buy our vehicles, we buy their vehicles. And that is how we get their vehicles.
And talking about exports.
Electric vehicles also is something which Suzuki has developed and are making. And that actually, to what extent they're getting technology from Toyota, I have no idea.
Joins us now, Senior Executive Officer, Marketing and Sales with Maruti. Okay, Shashank, Mr. Bhargav says that he cannot talk about margin, but every time when we speak to you, you do give us a sense as to how things are moving on the raw material side, on the cost side. Given that last year was a very, if I may say, very tough year for Maruti in terms of margins, will this year be a comeback year?
Well, I think Mr. Bhargav made that point already. It's so difficult to predict going forward what's going to happen on the cost structure front. Remember, in terms of any auto OEM, 75 to 77% of the cost structure actually is material cost. And while material costs have been coming down and been relatively lower compared with what they were about a year back, steel prices have firmed up. So it's so difficult to find out in net whether the material cost is going to come down or go up, and that is why it's become so difficult to predict the forward margins.
Shashank, the fact that Maruti is coming back with a renewed vigor in the SUV market, how will that change the dynamics this year for Maruti?
Well, surely I think it's going to be very positive, and we have said it that while our projections for the industry is that the industry will grow for between 5 to 7%, our projection for Maruti Suzuki is going to grow much faster than the industry. That means there should be an addition to our market share. So one of the big weaknesses which we have shown in the past few years has been our relatively low market share in SUV space. In the non-SUV space, for example, last year, we had almost a 65% market share. But in SUV, we had just 12%. While in Q4, it improved because thanks to our better availability of Brezza and Vitara. In this year, with the Fronx and the Jimny, and the Fronx, we started sales just a couple of days back. Jimny will be starting in about 3 weeks' time. We should give us much larger volumes in the SUV space. And in fact, we have said it before, we intend to be the number one player in the SUV market also, so that our overall market share goes up substantially from the 42% that it is at the moment.
How much, realistically speaking, the semiconductor problem is solved? Because a lot of auto companies are still not giving us the clarity on that.
Exactly. And I think the reason why nobody is able to give you clarity is because the visibility of semiconductor-based component supplies is not really good. Actually, we get weekly updates because it's a global crisis and buffers are non-existent. Because of the long period of shortage in this component. And that is why nobody is able to give you a clear picture. However, quarter to quarter, I can tell you, like last year, we lost about 170,000 units overall. In Q4, we lost about 38,000 units because of semiconductor shortage. In Q1 also, the problem persists. And we do hope that going forward from Q2 onwards, the situation will become better. We are already at that 94-95% type of level, but there are some models like the Ertiga, the XL6, the Baleno, the Brezza, etc., where we still find that there is a lot of shortages. And that explains the large pending bookings and the waiting periods that our customers have to endure because of this.
Understanding is that you have an order backlog of about 4 lakh units. Now that's a large, powerful, backlog. That's almost like a 3-month kind of an order backlog.
Yes, that's true.
Will that get resolved, or will that be addressed? Because if that gets resolved this year, your sales plus backlog, then you could be in for a bumper year.
Sure. I think, as mentioned before, quarter two onwards, hopefully, we should have much larger productions of those vehicles which are in short supply. And I mentioned those models just a while back. So hopefully, yes, we should add to those numbers in those models going forward from Q2 onwards.
When we spoke to you last time, you did say that, look, there is good news and there is bad news. Some component prices are down, but not all component prices are down. You've taken a price hike, but that was not good enough to go back to your historical margins. As we look into the future for FY24, demand you've already spoken about, let's understand the raw material impact then.
Yeah, so I mentioned just now that while there has been some softening in copper, in aluminium price, even the rare earth, rare metal prices, palladium, etc. But they are offset partly by the increased steel prices. It's about 6-7 rupees kg increase for steel there. And by the historical perspective, of course, these prices remain very high. So, for example, copper 2.5 years back was $5,200, went up to $10,400. Now around 9,000 or slightly less, but still, when you compare it with 2 years back, still pretty high. And we can't really see a situation where you will have those type of prices again, and it's very volatile, and that's the reason why we have not been able to give you a forward guidance on which way the raw material prices will move. At the moment, except for steel, they are a bit more benign.
Okay, so the only constant seems to be the uncertainty. That's the word coming in. Thank you, Shashank, for joining us today and talking to us about how the growth outlook is looking like. But shifting focus and talking about IT sector, because mid-cap IT earnings have been rather strong. In fact, our KPIT Tech delivered a constant currency growth of 8.5% in the quarter gone by, and the guidance for FY24 is rather strong as well. 27 to 30% growth on revenue and a margin profile of 19 to 20%. Let's try and decode the earnings with Mr. Kishore Patil. He's the co-founder, CEO and MD at KPIT Technologies. Mr. Patil, hi, good morning. Thank you so much for making time and speaking with us. I wanted to begin by asking you about the outlook going forward, because at a time when rest of the peers and rest of the IT companies are talking about uncertainty, headwinds, ramp downs, you are talking about a 27 to 30% growth. Is it the fact that the transportation ER&D segment is completely unscathed with what is happening across the globe, or there is going to be a time lag impact and there could be a slowdown as we move further into FY24?
I mean, good morning to you. I think let me take a little bit step back and then maybe explain to you what I mean by this. See, as you know that basically what you have to understand is what is the business model of every individual company instead of making it generic. And in our case, as we have been saying, and more we have been focused on basically automotive mobility and only on future technologies, and that too on specifically SDV programs. Now, these are the new architecture programs which they have to introduce the cars in next 3 to 4 years. And once typically the OEMs commit to these kind of programs, there is not much, I may say, flexibility for multiple reasons. If they compromise on that, then their future launches of the products will get compromised. So that is the reason there is a bit of a stickiness and there is a better clarity over the programs. And as a company, as we have done that, as we have been saying that about 70% of the programs we work globally, I think that gives us that visibility. And that has also, if you remember last 2 to 3 weeks, 3 to 4 months, we have announced 2 significant engagements with both Renault and Honda. And that is basically allowing us to give this confidence. I'm not trying to generalize this. It is a very specific situation relating to the company, the focus, and more importantly, the leadership position we have in the sector in which we are operating.
Sure. No, Mr. Patil, that point is taken. Given that you're in a niche area, the sector thematics are a tad bit different. But since you talked about the 2 deals, in the quarter gone by, the deal wins came in at the record high level, led by the Honda order itself. A, is this kind of deal momentum likely to continue? And secondly, are there any other such large deals in the pipeline which is likely to materialize in the next 3 to 6 months?
Yeah, I think, again, just going back, we are a very, very focused company. So we have about 25 clients we work with. And the way we have identified those clients where we will strategically engage. Now, for example, you all know that we work with Cummins for a long time. There is a historical reason. There are BMW we work with in the long term. So all these clients are very, very strategic. And there are, of course, other clients beyond this. So that's something which is there. And we have been working, and it is scaling, and it is scaling to a significant level, and the same level, if not more, some cases than what you see in the large deals. But I think these are the larger engagements which we have specifically come out and say, where the clients have taken a different view, and they have taken it in a holistic, long-range, full program view now, and that's where we were getting engaged in that way. That's when we have made the announcement. So to tell you, our basic business is the same. Our business model is the same. We may or may not announce the engagements, and it really depends upon the client and the stage at which we are there.
Telling us,
but
and I
your
don't.
Answer, but to your answer, the growth continues across the client.
When you're saying you're confident of a 3 to 5%, 3 to 5 year growth, would you be able to maintain this run rate of 20% plus even on a higher base for next 3 to 5 years? But that means technically, if you're growing at 20% plus, 3 years, your business is doubling.
I mean, we have more or less done it over the last 5 years, apart from one year. And as I mentioned, currently, that's how we see the external environment. That's what we see. We, of course, we give at this level how is the external environment and how we are, and specifically looking at where our spend of our clients is and how we are positioned there. That gives us confidence to make a broad statement, and I think that's what people wanted to know. But of course, we will always give a very specific outlook for a year.
So net, what I infer from what you're saying is that 20% growth rate is going to be maintainable at least for the next 3 to 5 years. That's the kind of visibility you have due to the stickiness of the client spends. I also wanted to talk about the JP Morgan report that came just a few days ago, and we had seen a big reaction in the stock. And there, one of the concerns was that the company has not diversified much, high exposure to a particular vertical, and the client concentration is also quite heavy. Your reply to that?
No, I think I would like to stick to what is the strategy of our company, and different companies take different view. I mean, they are entitled to take their view. There are other companies as reputed and multiple companies who have taken a different view. We actually believe the focus is very important. I think what is highly important is the leadership, global leadership, the way KPIT is engaged. It is a very significant part. Because then you are in a position to maximize the growth opportunities, as well as in case where the market gets, if I had to say, a little soft, you are in a position to eat into the market share. So, and we believe that that's the only way to create a true global leader. And the opportunity, in our view, is 5 to 10 years consistent increase in the spend, which has been which has come out of multiple reports. So that's our view. I do not want to react to what other people say.
Atul, your margins have also been fairly sticky within that 18 to 19% range of late. You have talked about bringing it up to 19 to 20% in the coming year, but give us a bit of medium-term outlook there as well, because you were in a bit of investment phase earlier. Are you likely to head maybe towards that 20 to 23% mark?
We have always said that in next few years we will cross 20, and if you see every year we have increased our EBITDA by a certain percentage. In some cases, 0.5%, 1%, or whatever. And what we have been saying is we are reinvesting anything beyond that into our growth, and that is what is paying dividend. Because first, this is a very transformational phase of automotive industry. Technology changes very quickly. We have to keep on investing into technology. We have to keep on investing into building talent. The higher growth also brings that, and specifically the specialized client.
Patil, on that note, we let you go. Thank you so much for joining us today. So talking about how the opportunity is quite strong in the vertical for the next 5 to 10 years, expecting to stay above the 20% growth rate for at least next 3 to 5 years. And the margin is something also which is expected to head above the 20% mark for the next few years. The stock sitting with a gain of around 3.25%. On that note, we'll slip into a very short break. Don't go anywhere. We'll track a lot of other result reactions plus the markets when we come back.
Welcome back. 17,832 on the index. It's the small cap end of the market that's up about 0.5% as we speak. I just want to identify some movers in that arena. And you've got a City Union Bank, BSC, Lakshmi Organics, IDBI Bank, as well as RBL Bank that are abuzz. But let's keep it then with IDBI Bank and get you all those exclusive news breaks. The divestment from the government and RBI is what we're picking up from sources, as the government wants to complete the divestment by December and the financial bids will be invited by July. Let's take it across to my colleague Prakash Priyadarshi, who joins in with those details.
Yeah, sources are informing that the disinvestment process of IDBI Bank is moving in the right direction, and government is hopeful to complete this whole process by December 2023. DIPAM is expecting to receive multiple financial bids for IDBI Bank, and due diligence on queries raised by investor during EOI stage are being done at the moment, and it will continue during the second stage as well. We are also given to understand that DIPAM is planning to invite financial bids for IDBI Bank by July 2023. Sources are also informing that all the important factors, including global and domestic, will be taken into consideration before inviting financial bids. Since disinvestment of IDBI Bank is a unique kind of transaction, so detailed and careful evaluations are being done at every stage, including security clearance of prospective bidders. Government is upbeat on good response from investors so far, and then hopeful to complete this whole transaction by end of this year.
Okay, Prakash, thank you so much for bringing us one side of the story, but let's try and go across to Ankar to understand where do we stand with respect to RBI clearances for the same.
Yes, sources say that Reserve Bank of India may have given an in-principle nod for the potential bidders' due diligence. In the case of IDBI Bank, what we have learned is that at least 4 of the 5 potential bidders may have got a green signal from Reserve Bank of India, and the rest due diligence is still underway. Sources also indicate that this nod is not the final, but during the process of divestment of IDBI Bank, the due diligence by the regulator will continue, and as and when it is required, the regulators will reach out to the potential bidder for any clarification, if at all it is needed. As far as the stake sale of IDBI Bank is concerned, we understand that the access to the data room will be given to the potential bidders very soon, so that they can go through the details of IDBI Bank, and then RFP will be given to them, so that the final bid can be submitted by the potential bidders, and that is also expected very soon. But all in all, what we learn is that the preliminary work of Reserve Bank of India is completed by now, and we may move to the next step of the divestment of IDBI Bank, and soon we may see that more than 60% of stake of government and LIC may be reduced in IDBI Bank.
All right, thanks so much for joining in, Ankur, and giving us all of those details. So watch out for IDBI Bank. That's clearly in the spotlight. But let's move right on then. Tushar Bora is joining in. He's the co-founder and fund manager at MK Ventures to discuss his outlook on the markets as well as what the view is on individual sectors. Thanks so much for taking time out and joining in. And Tushar, clearly financials dominate the overall portfolio. So I just want to understand how you've read into the kind of quarterly earnings and whether or not you believe that banks will see a steady run in Q4.
Yeah, thanks for the opportunity. Good to be back on ET now. I think financials have started on a very strong note. The earnings reported so far across banks and NBFCs, in general, there's a very positive read-through. Financials looks very attractive. Say next couple of quarter earnings momentum looks to be very strong. However, we have to also be cognizant that we are clearly in terms of the cycle, the credit cycle it's on a very strong note right now. But I expect that over a period of time there will be some moderation here, and once the credit cycle cools off after peaking, whether the prices would continue to run up is what to look at. However, on the whole, I think earnings looks good. Banks clearly is an area to continue to remain invested, and you'll get a lot of opportunities to shift between banks. So I'm positive on financials overall as a pocket.
When you say shift in between banks, what are you referring to?
No, I mean, so let's take for an example the large cap side, right? HDFC Bank, and Kotak have not really performed last 3 years, and some of the other banks have done much better on a relative basis. So I believe that there would be shifts between the between banks from some of these ones who have performed in the last couple of years, the prices have run up, to some of these larger banks like HDFC and Kotak maybe, which have not yet done that well, say in the post-COVID period.
Typically, when you go through a cycle like this, everyone should participate. But right now, there is a fight for liabilities. Not everybody is getting a strong share of liability. Big banks are getting it. Some PSU banks are getting it. So is that one should focus on? Anybody who's getting liability or fixed deposit, those are the banks which will do well?
Yeah, so banks which have a strong liability franchise will continue to do well. Even NBFCs for that matter, selectively we should be looking at, because since the start of the rate hike cycle, in general NBFCs have not done that well, and there are pockets of opportunity in NBFCs also. But yes, large banks with strong liability franchise will continue to get their more than their fair share of business as well as do well in markets going forward.
If, let's say, financials have a 35% weightage in benchmark indices, should one stick to 35% weightage, or it's time to bring it down to underweight?
No, I would not go underweight on financials, not yet. See, if the Nifty has to move to a new high, financials have to play a very important role. So I would certainly look at financials to, continue to lead the direction, the positive side. So I wouldn't go underweight on financials. I would just say that, in fact, across sectors, I think it's more important to be very choosy and selective, discerning in what you are owning, rather than to try and take a overall sectoral call. So I would continue to be bullish on financials. Just look more closely as to what I'm owning at a given point in time for next few months.
Tushar, what's the outlook when it comes to the entire consumption space as a whole? Do you believe that in times of this sort of choppiness in the markets, one can cushion the volatility with a decent enough exposure to some of these defensive sectors like FMCG or even pharma for that matter?
Yes, so FMCG, I think the earnings reported so far have been good. Pharma, it's still early. A lot of earnings are yet to come. But I think definitely it's time to shift focus, especially pharma, which I track very closely. I think there is a lot of momentum still left. In fact, pharma, we've seen last 1 year in a number of stocks, on compressed earnings because of various issues. Let's say raw material prices were much higher, oil prices in general were higher. That affected them on multiple points on the P&L. I think we are clearly moving out of that phase. The sector looks set for a fresh momentum. It's very early stage, but I like pharma as a pocket at this point. FMCG, I'll be more selective. I think while earnings look good so far, whatever has been reported, but the valuations still are much higher than comfort for a number of these stocks. So I'd be more selective in FMCG. I'd be more willing to go, say, aggressive in pharma at this point. And especially in pharma on the small and mid-cap side, a lot of these stocks which are not very widely tracked and are attractive at, say, high single-digit or very low double-digit PE multiples could really prove to be a very good opportunity for the next 12 to 15 months perspective.
Pharma space for us. I mean, 2020-21, if you had a COVID portfolio, hit a home run. If you're in the API business, names like Loris, DVs, they did very well. What within pharma? Domestic MNC, API, non-API, generic, non-generic. What do you like there?
I think, so if you see US, the larger pharma companies have started to now report better earnings. The commentary has improved. On the large cap side, Sun has really reported very good earnings last 4-5 quarters on an overall basis. I think it's time to start looking at these companies more closely. But I continue to prefer on the whole the API and CRAMS space. CRAMS said, while I don't want to comment specifically, but since you've asked DVs and Loris, I think probably the next few quarters would continue to remain challenging because clearly some of the COVID-led opportunities need to be filled up with regular business. But I maintain a very long-term bullish stance on the CRAM side. And on API side, Nikunj, across the board, the valuations have compressed to high single digit, maybe 10-11 times PE on FY24 earnings in a lot of cases. This is a classic case of depressed times and depressed earnings depressed multiples coming together. So API, I think from a percentage point of view, you'll see very, very strong returns next couple of years. But for a lot of these institutions, the API names may be much smaller in size, and so they will continue to prefer large cap names. So I believe the domestic business, in fact, in that context, Mankind IPO closes today. I wouldn't be surprised if it sees a very, very strong institutional participation in main book and beyond listing. It continues to do very well. So I am bullish on the overall space. US generics, I think, has also bottomed out as an opportunity. Some very good companies available here. But within that, preference would be on API and CRAMS going forward also.
Where are you ready to bet on a new cycle? I mean, let's say if you bought banks a year ago, you bought the beginning of a cycle. If you bought IT in 2020 at the peak of COVID crisis, you bought the beginning of a new cloud adaptation cycle. Defense, new cycle started in 2021. Where are these new cycles starting?
So I think these cycles have started, like you mentioned, defense, capital goods, manufacturing-led themes. These cycles have started railways. We've done one round where everything has gone up. I think we will see another cycle in IT over the next 6 months. A lot of IT mid-caps have not done that badly on results. If, for example, ER&D companies, results have actually been much better. So only the large cap side, the frontline stocks have done much worse in terms of earnings. But IT, I would bet that we will see a bottoming out in the next 1, maybe 2 quarters and a start of a fresh new cycle. Pharma, I am bullish that a new cycle has just started. Infrastructure, I think, we are in the midst of a cycle right now. The valuations are still quite attractive for a lot of the infrastructure players. We are clearly in a seasonally strong execution quarter. Q4 earnings that would get reported. I believe we'll see good traction across the board. And next 1 year, infrastructure should be a good space to own. So, and also it's not that, something like defense or manufacturing, it's not that the opportunities are gone. We've just seen the first round, when typically it's the hype phase when everything moves up and then everything will come down systematically. And the second round of the cycle will start in defense and manufacturing and capital goods and engineering stocks, where you will have to be more selective. It will be a bottom-up led cycle. The specific companies will really outperform the entire space. And if you get your bets right, there's a lot of money to be made next 3 years, 5 years in these sectors also. Autos being another one. Within autos, I prefer OEMs at this point because clearly ancillary companies have relatively outperformed and valuations are also much higher in a lot of cases. So OEM as a pack, I think it's time to look at that and selectively on ancillary side as well.
ATM, do you think the tide is turning for them? Because that's the most talked about view. I mean, half the world is divided that they will never make money. Half the world is divided that they will make a lot of money in 3 years.
Which sector I missed?
No, the entire fintech consumer tech space, whether it is Zomato or Paytm, The businesses are different, Tushar, but we always tend to classify them as one.
Fair enough. Nikunj, I have generally been bearish on fintech and consumer tech spending. As a personal preference, I don't like businesses which lose money today in the hope of making it sometime in the long distant future. But so selectively, there are some franchises which are very strong. So, for example, logistics as a pocket, I think some of these companies are doing really good work. Even fintech, clearly at the time of IPO, there was a lot of hype and obscene valuations. Now, the businesses are starting to catch up and commentary started to become more moderate. So, be it Zomato, be it Paytm, there's no longer an air of, frenzy around these names, which is a perfect environment to actually dig deeper into the space. And as a house, we have, looked at these opportunities much more closely in the last, 3 to 5 months than we did at the time of IPO. And we think there are some very good opportunities definitely available, both fintech and consumer tech side, consumer related stocks. Just that, it's not necessarily a time to act, across the board. It's a time to continue to do your work, and selectively you'll get the times to buy, and you make the best of them.
I also wanted your take regarding the IP of Mankind Pharma. We have seen decent amount of subscription so far. What's your recommendation on that?
So, without getting into the merits of fundamentals of Mankind or any specific company related points, I would like to highlight a couple of points. I think people prefer simplicity of execution. It's a simple business. You have to only track execution. In case of domestic pharma, even the execution tracking is very systematic. You have a monthly readout of how each segment is doing. Even at a product level, you get data on a monthly level. So domestic pharma is a much easier beast to track. People like it because there's a certainty of earnings. There is less volatility, less regulatory volatility, or price erosion. These kind of things are much lesser with domestic pharma. Within that, I would give credit. Mankind has built a very strong consumer franchise over the last 15 years. Coming into a crowded field already, they've done really well. And I think they have a very good chance to stand out even as a stock. Just to give a data point, there's about, say, 1.3 lakh crores of mutual fund investments in pharma, give or take 10,000 crores. Of that 1.3 lakh crore, I believe more than 75-80,000 crore is invested in the top 5 or 6 names across healthcare, diagnostics, hospitals, all three. And of that 80,000 crore, my bet would be that from the time the cycle peaked originally in 2015-16, most of these investments have actually not made any money. Some of them would have probably made a double-digit negative CAGR in the last 8-9 years. So there is definitely a vacuum at the top. People are looking for large-cap quality pharma stocks, which are easy to track, simple and execution-focused, and where you have peace of mind. Then you can typically deploy a large amount. I think Mankind fits well in that category. I wouldn't be surprised if it has a good listing, but more than that, if it continues to deliver very strong returns post-listing.
Your time. Thanks so much for giving us a deeper insight as to what the strategy is, your outlook on individual sectors and the markets as a whole. Just a quick check-in on the index at 60,400 for the Sensex. We're hovering around the 17,840 mark on the Nifty. Let's move right on then and focus in on Poonawalla Fincorp. Came out with numbers with net profits jumping to 181 crores, with the company recording the highest ever quarterly disbursement growth in Q4. My colleague Ajay Sharma caught up with Abhay Bhutada, the MD of Poonawalla Fincorp, to decode the earnings. Listen in.
Last year we did 37% AUM growth, mainly because of the consumer and MSME segment. So we have overall machinery loan, supply chain, loan against property, personal loan, loan to professionals, medical equipment loan. So we have multiple products and we are targeting basically the segment which is a formal income segment, bureau tested segment. Market opportunity is huge. On the basis of that, we have given guidance from last quarter that we will be able to grow 35 to 40%. So current year also we'll stick to the guidance of 35 to 40%. And in terms of return on asset, we have crossed 5% in the recent quarter. However, on a steady state basis, we'll be able to maintain 4 to 4.5%.
If you could share some outlook for a full year basis or roughly 3 to 4 quarters far out, what kind of outlook can you share on growth and also on ROA?
So, as I discussed, the growth we are looking for quarter on quarter basis 8 to 10%, year on year basis 35 to 40%, considering the market opportunity available and our base is low. Still, we are at 16,143 as a AUM. In terms of ROA, on a quarterly basis, last quarter we crossed 5%. For the entire year, last year it was 4.4%. But on a steady state basis, we'll be able to maintain the range of 4 to 4.5%.
Right. Abhay, talk to us about how's the breakup looking in terms of secured, unsecured for your entire loan book, and also if you could share on your on your loans front, the raw material, the capital front, what is the breakup on short term and long term kind of capital available to you?
Right. So if you see secured, currently it is 50-50 secured and unsecured, but going further, considering the opportunity available, we'll do secured 40%, unsecured 60%. Again, in terms of short-term lending, we target 20 to 25% short-term lending, 70 to 75% medium and long-term lending. In terms of borrowing mix also, we got AAA rating from CRISIL and K recently. So considering that, we started short-term borrowing and will target more short-term borrowing going further. And we got a couple of bank loans last year. So initially target was bank loan. Now this year target will be more than 4,000 crore will raise from short-term borrowing.
Abhay, also we saw in this quarter that your OPEX is actually witnessing a decline on a sequential basis. Can you talk to us how are you achieving this, especially at a time when your AUM growth is around 35% plus?
Right. If you see last year, our OPEX at a standalone level was approximate 800 crore. So I think in terms of absolute number, the current year it will be the same number, approximate 800 crore. Last year it was 6%, majorly because of the ESOP charge. We have given ESOP to more than 400 people. So that charge itself was around 150 crore. So around 6%. But if you see the real ESOP charge and other, if you exclude, that was much lesser. So current year, you will see 2% reduction in the overall OPEX in terms of OPEX to AUM. So it will be around 4%. And going further on a steady state basis, we'll be able to maintain below 3 level.
Let's talk about the other part of your business, and that is risk management. Asset quality, the levels which you are wanting to maintain or achieve, because on the one side there's very high growth, 35% plus. How are you managing risk? What are your controls in place, and also the asset quality levels which you would definitely confident of maintaining?
You're right. I think it is very important to understand growth is very easy considering the huge opportunity available in the segment which we are targeting. At the same time, we need to collect the money. But we are in the risk business. We are not in the collection business. You see the overall last 2 year performance, new book is performing really well. The reason is on the consumer side or on the MSME side, the segment which we are targeting. So it's a combination of fintech, bank and NBFC. We behave like a fintech in terms of user experience. We understand practical call, understanding of the NBFC, the cash flow based lending, and we started targeting customer of a bank. So the segment which we are targeting is a credit tested customer, bureau tested, formal income segment. We get a lot of data input from GST, TDS, or the statutories of the customer, the business vintage and the bureau vintage. So it's very easy for us. It's like credit by invitation. See, we have built the risk culture and the overall credit culture in the organization. That was our main motive. We have a very strong analytics team. On the basis of that, the overall market opportunity of the live bureau base is more than 20 crore. And still, we have more than 2 million customers live with us. So the base is very low. We don't see any challenge next 4 to 5 years, and we don't cater to new to credit segment. So considering all this, we are quite confident to maintain our management vision 2025 that we will maintain net NPA below 1, and you can see further improvement in the asset quality as well.
Excellent. One last question, Abhay. I'd like to know what is the status of your sale of housing subsidiary. When is the money expected? If you could tell us what level is it right now?
So we have received lenders approval. We have received shareholders approval. Now we are waiting for RBI approval, which is under process.
All right, Abhay. Thanks very much for chatting with us and sharing your thoughts on your operational performance and way forward. Thank you very much for your time.
Thank you so much.
All right, that's an insight as to what the management of Poonawalla FinCorp has to say. They're looking at a 30 to 40% growth guidance, and going down the line, they're going to maintain an OPEX of about 400 crores, and they're confident that they will maintain net NPAs below 1% in line with their vision for 2025. The stock on fire in trade today. What else is on fire then when it comes to the charts? Let's find out on our Chartbusters segment. We've got Nooresh and Kunal right back with us. And Kunal, let's discuss ICICI Bank.
Well, yes, Avan. ICICI Bank delivered results, some time back, and the stock remained into a very muted kind of a price action. But then the historical charts and the indicator which I want to map up for ICICI Bank was more of a stochastic indicator breakout. It's very interesting because over the last 2 or 3 years, whenever the stochastic indicator breakout has actually happened, it's catapulted the stock, to a range of more than 15 to 20% higher from the previous levels. Now, this was the start for ICICI Bank when the stock gave a breakout in terms of stochastic indicator. The stock, which was placed almost at 450 levels, moved up to towards 550 mark. Then 2020, we all know what happened into most of the banking names. Again, the stochastic indicator gave a breakout, and the stock moved into a very strong uptrend, which lasted for more than a year or so. Same was the case over here in 2021, where the stock moved down from 600 to almost 740, 730. The recent charts indicate that the stock is now confirming a breakout in terms of stochastic indicator, which means we could possibly be looking at ICICI Bank not just hitting back the previous highs, but crossing about those levels, but a very high probability that from here on to say the next 3 months or so, we could be looking at 1000 plus 1050 as a potential target for ICICI Bank.
Okay, so ICICI Bank heading to that 4-digit mark really soon. Let's see when that happens. But in the meantime, let's go across to Nooresh as well and spot his chartbuster idea.
So that's an idea for Apollo Hospitals. The stock has gone sideways for the last year and a half. In the near term, it has been getting into a tighter and tighter range, classical symmetrical triangle formation here. If you look at what has happened over the last 1.5 years, a lot of hospital names have actually gone up, made new 52-week highs and all-time highs, and made a clean move. Apollo Hospitals has been a relative underperformer. Going forward, there could be a catch-up. A breakout point for the stock would be around 4,500, currently at 4,370, 4,400. Is a good time to start accumulating the stock. Eventually, once it breaks out, should make a quick dash towards 4,900 to 5,500. Buying at current levels, the risk is 100 points, 150 points at current levels, but upside could be 400 to 800 points. So out here, stop loss at 4,250 and a target price of 4,900 to 5,500 in the short to medium term.
Stock-specific strategies as well, and the mid-cap bets and cracker stocks coming in from a technical experts. Kunal, what's on your radar?
Tata Motors is a stock which I would bet at current levels. It's come back towards a momentum. Being expiry day, I think could be on the verge of a breakout. 500 as an immediate target. Stop loss at 470. And Poonawalla FinCorp, something which I recommended a week back. That stock has moved up quite well. Would revise the targets higher to 340. Traders could look at a fresh bet even at current levels and trail the stop loss to 310.
Okay, Nooresh, what about you?
So first would be a buy on Federal Bank, seeing a lot of small cap banks give a breakout, Federal being the best one in terms of relative strength. Stop loss at 130 and a target price of 150. Second is a buy on Mahanagar Gas Limited, setting up for the next leg of the move about 1020, 1030 levels. Stop loss at 980 and a target price of 1100.
Okay, Nooresh, those are the top recommendations coming in at this point of time. For the markets looking steady, not much to complain. In terms of specific stock movers, pull up the stock of Raymond, 7% higher. We were talking to you about the exclusive details wherein it seems that Godrej Consumers is an advanced stock to make the deal with Raymond for its consumer care business. There's a press conference later today as well. So the street is banking that could be perhaps the announcement that comes through. City Union Bank, 6.25% higher. L&T Tech is reacting to its numbers, 5% higher. And then Syngene as well is the other stock. On the losing side, it's HDFC Life down about 3%. And then some other pharma names like Lupin, etc. also on the back foot. On that note, slipping into a very short break.